What up, investors? It's February 20th, and thank you for joining me. I want to go over this earnings week prep coming up. Okay, we got some Ecodata, some companies reporting about retail earnings for this week, to the likes of Home Depot and Walmart reporting very important conference calls and numbers to pay attention to there. There's very few companies in this market that know the path of the economy the way that Walmart and Home Depot do, okay? So let's get on with what we want to talk about in this video. Before you do, of course, or before we do, please hit that like button and hit subscribe, and hopefully learn something from these videos. We have some fun in the meantime. Let's get to it. So here we go. Let's talk about the markets real quick. Looking back last week, of course, and we saw the Dow Jones and the S&P down several weeks in a row already. Not too bad this week as far as the losses for this week, but at the same time, these losses pile up, and it's kind of like a slow bleed. We don't want to see that over and over again every week being loser weeks, okay? We got to keep an eye on that. NASDAQ does eke out the win at 0.59%. That's your tech, your technology stocks mainly, okay? Now, everybody's still worried about the Fed. That's the big worry. That's what the market is being driven by the most. The Fed, the Federal Reserve, okay? We had CPI and PPI last week hotter than expected, significantly hotter than expected for the producer price index data that came out last week, and also the sales report for January. So it shows you that the economy is not slowing. That brings on fear of the Fed, okay? That's what we don't want. We want the Fed to stay hands off, stop hiking rates, and letting this economy jive without hiking rates and, suffocating us into a recession, of course. Okay. Now, general industrial production changed from December. Not good. We want to see numbers weaker than expectation. Not so much weaker than it shows that we're going into recession, but weak enough to keep the Federal Reserve off our faces. Okay. Now, housing starts declining month over month, about 4.5%. Building permits slightly higher. That means the housing market is pretty much even where it's at. And as far as what I follow, it doesn't look that it's going too far down any longer or much longer than it has been, okay? Jobless claims still pretty strong, okay? Came in at 194,000, decreasing by 1,000 the prior week. Jobs numbers look strong, guys. We saw that jobs report from a couple weeks back. Very, very strong. Not sure that I expect that to change anytime soon, okay? US dollar at about 104. Remember, we want to keep that pretty low. We don't want to keep that over 105, I think, is the magic number. That's when investors are going to start spooking at that 105 number and looking at companies that do business overseas to repatriate those profits, okay? WTI mid-70s per barrel. Pretty surprising to see that there. Looks like supply of oil is plentiful out there in the world economy. Looks like Russia's producing. Looks like the Middle Eastern's producing. Looks like we're producing tons of oil. Also, the U.S. government has released a ton of oil into the markets, trying to artificially take those prices down for the U.S. consumer, for the benefit of the U.S. consumer. Of course, they're going to have to repurchase a lot, and they've said that 71, 70 range is where the U.S. government starts to repurchase oil to fill back their supply, okay? And then at the end of the day, they make some profit off of that. That's good. That's benefit to the taxpayer at the end of the day. So hopefully that sticks around that trading range, and we can do better with our DVN position, our Devon Energy position, which we're now building out in our portfolio, okay? The 10-year 382, we don't want to see that. If that hits 4, I think a lot of people are going to start to panic in this market. Let me give you a better 4 here. There you go. If that hits 4 on the 10-year, you're going to see massive panic in the markets because now the bond market is working the way it's supposed to. So you have fierce competition for stocks as an investment class. So if you have bonds that in the last 3 to 5 years were earning you next to nothing, now they're yielding a significant amount. Why would you put money in a unprofitable company and buy their stock as opposed to not taking any risk and putting your money on a 10-year bond yield or even a 2-year bond yield, which is already over 4% yield? The only problem is that you have to roll those over after 2 years, so it's a little bit complicated when it comes to bonds. I'm not a bond expert, so don't get me all going on bonds, okay? Now, consumer discretionary utilities and consumer staples last week, and energy was the biggest loser. That allowed us to build or start building our position in Devon Energy and get some energy exposure. Now, for us, we're kind of winding down our earnings season. We're pretty much halfway there, and pretty much it's all hit the peak, and we're going downhill on our earnings seasons. We had DraftKings last week, which showed a phenomenal quarter, much better than expected. I'll show you guys here on Seeking Alpha. We beat EPS by 5 cents, revenues beat by 55 million, and we had some great numbers on average revenue per monthly unique player, arm up, okay, $109 in the fourth quarter, increase of 42% compared to the same period in 2021. That's a significant gain for DraftKings, and I'll be talking about that in a later video. I won't get too much into it here in this video, but very happy with the DraftKings earnings. And we of course have Smart Rent reporting on March 8th. That's also our smallest position in our portfolio. I'm looking to build this out somewhere under $2.50 a share for Smart Rent. That's kind of my happy place in which I can take and not feel too bad about raising. Our cost basis right now is about $2.30 a share. Anything under $2.50 I think is okay to start a position and build it significantly as it goes lower. Hopefully it goes under $2 a share because it's very small for us. But if it doesn't, totally fine, and we'll let it ride. Right now, the high I've seen it is a little bit over $3 a share as far as Smart Rent goes. This is a company with a long road of profits, a lot of unrealized business. So this is a little bit of a sneaky winner here for our portfolio. We of course, have Planet 13, which has made no announcement as of their earnings for Q4 2022. We're waiting for that announcement. Same thing with Honest Company, no announcement yet. That probably has a lot to do with their new CEO, which we're waiting to hear from. So hopefully we hear something very positive from Honest Company. I think that the key to that is to see what Target is doing. So Target is the one. Let me write out Target here. Kind of hard to do with the mouse, but Target is the main seller, I think, of Honest Company, especially in a goods-based sort of way in which people are no longer going online to order things. Target is the place where people are getting Honest Company products, and Walmart as well. They've expanded to Walmart. Hopefully, we'll hear something good there. Okay, now and Devon Energy, of course, our newest move in the portfolio. Right now, our cost basis is 56 or a little bit under 56, like 55 and change. Might as well call it 56. Stock last I saw was 53, which is good. We're looking to be adding to our position. If it falls, hopefully falls under 50, and we can really pounce on that bad boy, Devon Energy. Now, let me show you this. And here's Devon Energy on Yahoo Finance. You'll see this is a great quality business, excellent quality business, trading a 5, almost 6 times earnings. I mean, that is unreal cheap, okay? And at a forward basis, 6 times forward earnings. So this is a very inexpensive stock that is a quality company with great management. Reported a couple bad things. We'll get into that in another video as far as what they reported and what our theory is for Devon Energy. But you're getting paid to wait. Any day of the week, you're getting paid to wait. Almost a 7% dividend yield at the moment. So very happy with our Devon Energy position. This is a long-term winner for us as far as a dividend payer. Not so much of a share appreciation. If you look at a 5-year chart here, you're not going to see much share appreciation. Maybe to that 70 level, I believe. But it doesn't really matter for us. This is a stock that's a defensive play in a higher rate environment with a potential recession in the future, yielding 6.68%. Definitely very interested in that. We'll keep building that out into a major position to rake in those dividends. Now moving on to Teladoc Health. They report this week on Wednesday after the close. Okay, we'll keep a close eye on Teladoc and see what it is. See what they say. Okay, this is a very long-term position for us. It's definitely one of those Kathy Wood ARK names. I don't like when ARK Invest gets involved in one of my stocks. I really hate it. I don't like it. I hope they never talk about Palantir ever again, okay? Hopefully never. And then Marvell Technology, March 2nd. That's when they report. This is one of the semiconductor names that we have in our portfolio. Very exciting name. It's a top pick for a lot of analysts out there. So we're definitely willing to buy more Marvell Technology if the price allows us to, if it falls under $40 a share. Right now, trading at about, I think, $43 a share. And then Rocket Companies on February 28th. That's the week after this one. And we'll be hearing there from the CEO and how he's stepping down in June. That's Jay Farner, the longtime CEO, co-founder of the company. He'll be stepping down and looks like he's retiring. He's been there for ages, so don't blame him for retiring there, okay? Now, the economic calendar for this week is showing just a couple major things here that we want to look at. We have existing home sales. We always watch that one. The FOMC minutes on Wednesday. So the FOMC minutes, not a lot of new things come out of the FOMC minutes. That's of course the transcribed, the transcription of the minutes, or not the minutes, the meeting of the FOMC from last week, from when they decide their rate hikes. I think we're going to see a lot of language there that would tell investors which way they're leaning to. And of course, I think it's going to be higher for longer. I don't think anybody's going to be talking in the Fed about pausing or taking it easy or being dovish. Not going to see that, okay? Now we have John Williams. That's Fed speak, and that's what they call Fed speak. This is a voting member of the Federal Reserve, and he's flanked by Bostic on Thursday and Mester on Friday. The reason here I have them in yellow is because these are not voting members of the Federal Reserve. So they're usually a little bit more wild with their assertions, the way they're leaning. It doesn't mean you don't listen. I think this is Atlanta. This is Cleveland Fed. So at the end of the day, they usually they're more broad with the range. Excuse me, they're more broad with the range of what they're talking about in their speeches or their speak essentially. So very loosely watch these guys. Very important to watch this guy for sure. Williams over Bostic and Mester any day of the week. Okay, we have GDP on Thursday. Very important. GDP read and new home sales on Friday, along with core PCE. PCE has been called the Federal Reserve's favorite measure of inflation. I don't think that it is anymore. I think CPI and PPI is their favorite sort of read on inflation. This kind of reads a little bit different than CPI. CPI, if you think about it, is just price changes of goods, of a basket of goods over a monthly period, month over month, or yearly period. This gives you the yearly move and monthly move of the change of behavior of the consumer. Is the consumer reacting to prices a certain way by switching one good to another? So that for me doesn't tell me too much, but the Federal Reserve seems to like that a lot, so be watching it for sure. And then here we go for the week. Retail earnings. We start with Monday after the close. Nothing here that we like Monday after the close on President's Day. Not many important people report today. And then Wal-Mart and Home Depot before the open tomorrow, early morning. Okay, that's gonna have a lot of press covering these two. Okay, and like I said in the beginning, nobody can tell you how the economy is doing better than a Walmart. Very few companies out there can give you a good, accurate read on the health of a consumer and the health of the housing market like a Home Depot can, okay? So we'll be watching these very closely in the morning. I'll wake up early and I'll be listening to these calls. I'll be listening to the news and the reports and sort of what the interpretation is from the CEO. And then we have Molson Coors also, same before the open. I always get interested in the beer stocks because the beer stocks are like the ultimate recession depression play. Whenever the economy goes lower and people are doing worse, people turn and they drink beer. That's just what they do. So very interested to hear what they have to say here as far as the outlook on a potential recession. Okay, and then we have, after the close, Palo Alto Networks reporting that's a cybersecurity play. I like cybersecurity plays a lot. They're very expensive, very volatile. They move very violently. We own CrowdStrike in our 401k portfolio. That's why I'm watching Palo Alto Networks. That's another really high quality cybersecurity stock. And then Toll Brothers is a stock I've always wished that I owned longer. We picked this up like at $13 a share back when the pandemic hit, and we let it go a little bit too early when we tripled the position to about the mid-30s. We let it go because we had a nice triple on the position. We should have waited. Would have had like a 5x gain, and it's been trading anywhere from the 40s to the 60 range in the last couple months. Toll Brothers, very good company, very recommended. If you're looking for a housing stock, this is probably my favorite housing stock, and I wish that, and you know, I have this in my bullpen, and one of these days I will own that stock again if it falls under 40 per share. I'm very interested in that stock. Okay. Now, NVIDIA, Wednesday after the close. This is, of course, artificial intelligence. That's the story with NVIDIA. AI. How are they selling to OpenAI, to Microsoft, to all these, data centers and cloud servicing companies that will power artificial intelligence? So expect a lot of AI talk from NVIDIA on Wednesday after the close, and then Teladoc we own for the account. Like we said before, very long-term position. So I'll listen to what they have to say. I'm not going to make any moves depending on how bad or good it is. No moves are coming from me on Teladoc. This is already a position that's already built out. Not interested in doing a lot more there. And then Dutch Bros and Coterra after the close Wednesday. That's your most active day for the portfolio. Dutch Bros, it's a stock I'm very interested in owning again. This was a trade that we made a little bit of money here. We made like a 50% gain on Dutch Bros over like a couple weeks on a trade. So very happy with that. Hopefully we'll be able to do that again. I think under 35, Dutch Bros is definitely a good trade target as far as a stock. Not an investment, but a trade. And then Coterra is a natural gas play, oil natural gas play. That's one that we like. And then Cheniere Thursday, that's another natural gas play. Now that we own Devon, we watch these natural gas plays and energy plays at the end of the day. And then nothing else interesting for the rest of the week on Thursday and Friday after the close. So that's it for today, guys. That's the earnings prep for this coming week. It's a short trading week, so expect a little bit more volatility. The markets tend to catch up with Asia and Europe, which are open on Monday. So we'll see how that goes. If you guys have any questions about anything in particular, please let me know how it can be helpful to you. Hit me up on Twitter, Instagram. Peace out.